Good day, students. This is Professor Buchholz coming to you for Chapter 24, Completing the Audit. And several learning objectives we have here. The first one is to design and perform audit tests related to presentation and disclosure audit objectives. The second, conduct a review for contingent liabilities and commitments. 3, obtain and evaluate letters from the client's attorneys. 4, conduct a post-balance sheet review for subsequent events. 5, design and perform the final steps in the evidence accumulation segment of the audit. 6, integrate the audit evidence gathered and evaluate the overall audit results. 7, communicate effectively with the audit committee and management. 8, identify the auditor's responsibilities when facts affecting the audit report are discovered after its issuance. Let's look at the first objective. So at this stage of the game, we're now at the end of the audit. The audit is now getting to its completion stage, and we're getting ready to get back to the office, look final things over, and release the audit report and the financial statements to our client. This is typically called Phase 4 of the audit, and at this point now, the auditors are evaluating the evidence that they've gathered to make sure they have enough evidence to support management's assertions for the material accounts. That's their goal at this point in time. One of the auditor's primary concerns is related to presentation and disclosure. Has management disclosed all the required information? And we take a look over here at a couple of examples. So, for example, occurrence and rights and obligations. Has management disclosed events and transactions that have occurred and pertain to the entity? Meaning, how can we determine this as auditors? Let's look at debt contracts to make sure that accounts receivable are pledged as collateral. If that's the case, that little tidbit needs to be disclosed in the financial statements. So what auditors will do is read the contracts. Completeness. All disclosures that should have been included in the financial statements have been. What do auditors do? We have a very lengthy checklist that basically has all the possible FASB disclosures that someone can disclose. And that checklist is filled out by the auditors one by one, and we actually go through it to make sure that all the proper standards have been filed. Classification and understandability. Financial information has been appropriately presented and described, and disclosures are clearly expressed. Examples of substantive procedures. Review financial statements to determine if assets are properly classified between current and non-current categories. Accuracy and valuation. Have the financial and other information been disclosed fairly at the appropriate amounts? What do we do as auditors? Reconcile those amounts included in the long-term debt footnotes to information examined and supported in the auditor's long-term debt files. The second objective. As auditors, we need to review contingent liabilities and commitments. So, 3 conditions are generally required for a contingent liability to exist. Number 1, there is a potential future payment to an outside party, or an impairment of an asset that results from a condition. Second, uncertainty about the amount of the future payment or impairment. And 3, the outcome will be resolved by some future event or events. So again, typically what may happen here is, let's go with the basic legal concept. A company's being sued. We're being sued as a company. And the lawyer says, well, And this is where we would go to a lawyer. Lawyer says, well, there's a remote chance that we will lose this case. There's a remote chance. Well, if there's a remote chance, the FASB says no disclosure is needed. If it's reasonably possible, again, more than remote, less than probable, footnote disclosure is needed. So in the notes to the financial, we would actually disclose that there is a pending lawsuit, but that we don't know when specifically we're going to be able to settle and what the amount will be for. If, however, it is probable, and the amount can be reasonably estimated, at that point, the accounting literature specifies a debit and a credit must be made. If the amount cannot be reasonably estimated, footnote disclosure is needed. Here's an example of what a contingent footnote could be. Again, various suits and claims pending against the company and its consolidated subsidiaries. It is the opinion of management based on current available information that the ultimate liability, if any, resulting from such suits and claims will not materially affect the consolidated financial position. Another example, look at the second paragraph. The company has agreed to guarantee the repayment of approximately $14 million loaned by a bank to several affiliated corporations in which the company owns a minority interest. This is telling the reader, hey, listen, I don't know if it's going to come true, but there's a chance I may have to pay $14 million for my subsidiary companies that I own a minority interest. How do we... Auditors are especially concerned about pending liabilities. And again, how do we do that? We look at pending litigation for patent infringement, product liability. We're concerned about income tax disputes that could warrant a journal entry, product warranties, discounted notes receivable, guarantees of others, and unused balances of outstanding letters of credit. The primary objectives in verifying the contingent liabilities. We have to evaluate the accounting treatment of known contingent liabilities to determine whether management has properly classified the contingency. We also have to look to see and identify any contingencies not identified, which again is your completeness, presentation, and disclosure objectives. Again, we need to be cautious. If there's a pending lawsuit that management has not told us about that they may have to pay, well, that's a disclosure. Now, a student might ask the question, you're talking about losses, Buckholz. What about gains? Well, FASB is very cautious here, and they'll say, no, we normally will not book a gain contingency. We don't want to do that. We may book some note disclosure, but we certainly would not book the debit and credit. What are the procedures for finding these contingencies? Number one, inquire of management about the possibility of unrecorded contingencies. Next, review current and previous year's internal revenue agent reports for income tax settlements. Review the minutes of directors and stockholders' meetings for indications of lawsuits or other contingencies. Analyze legal expense for the period under audit for indications of contingent liabilities. Usually, and each firm varies, we will look at 100% of the lawsuits, 100% of the legal expense, just to see what's going on. As part of the audit, we'll get confirmations from each of the major attorneys performing legal services. And we'll take a look and ask them what's the status of the pending litigation. We'll look at other areas of audit documentation. Again, legal expenses. We'll look at debt liabilities to see if there's anything that could indicate a potential contingency. And we'll examine letters of credit in force as of the balance sheet date. Another area of contingencies are commitments. Commitments, as they sound, is an agreement there the firm is committing to a set of fixed conditions in the future, regardless of what happens to profits or the economy as a whole. So a commitment could be that we're going to build another wing to our hospital, and we've made a commitment with the contractor to give him money over the next 5 years. Evaluation of known contingent liabilities. So if auditors conclude that there are contingent liabilities, they must evaluate the significance of the potential liability and the nature of the disclosure needed in the financial statements. CPAs often obtain a separate evaluation of the potential liability from its own legal counsel, especially highly material ones, rather than relying on management or management's attorney. So again, and note, this is going to be at bigger CPA firms. They'll have their own legal counsel, whether it's in-house or out-house. They'll ask them, gee, look at this legal letter. What do you think? Does this person really have a potential exposure? And what could that exposure actually be? Same deal for finding commitments. Usually that's part of the audit in each area that we do. Another way you can find commitments and contingencies, please make a note, is by reading those board minutes. The board minutes are excellent sources to find these things. Contracts and correspondence files and memorandums. The third objective, obtaining and evaluating letters from the client's attorneys. Usually, as part of the audit, we often get letters from the client's attorneys. So we'll send it out just like we would a bank confirmation, and we get it back from the attorney. And if an attorney refuses to provide the auditor with information about lawsuits or unasserted claims, well, ladies and gentlemen, that is considered to be a scope limitation on your audit, and then you're going to have to decide if you're doing a qualification or a disclaimer of opinion. Sarbanes-Oxley requires attorney who is serving a public company to report material violations of federal securities laws committed by the company to the SEC. The fourth objective, conduct a post-balance sheet review for subsequent events. So the third part of completing the audit is the review for subsequent events. The audit typically is done for a time period. So let's assume we're auditing a 12/31 year end. Your responsibility is as the auditor for a subsequent event goes from, again, the balance sheet date, which I just told you is 12/31, ends with the auditor's report date. So that is the period known as subsequent events. So in the example here, 12/31/16 is the audit report, is the balance sheet date. The audit report date is 3/11. They issue the financial March 26th. So therefore, if there's a subsequent event between December and March 11th, the auditors are responsible. What does that mean? Basically, let us imagine that on January 15th, 2017, A customer of your client declares bankruptcy. Your client has $1 million receivable owed from that customer. No allowance. Well, the minute you hear that, you would go back to the client and say, hey, you've got something that affects the audit at 12/31/16. We need to make a debit and a credit at this point in time. So there are two types of subsequent events to worry about. Those that have a direct effect on the financial require adjustment, debit and credit, and those that do not have a direct effect, no debit and credit, but may have some sort of disclosure. Perhaps we've got a situation where a pending lawsuit comes up. All right, well, now that the lawsuit has come up, we need to disclose it after year end. What would be an example again? Declaration of bankruptcy by a customer with an outstanding AR balance. Settlement of litigation at an amount different from the amount recorded on the books. Disposal of equipment not being used in operations at a price below the current book value. Examples of those for which disclosure may be required. A decline in the market value of securities held for temporary investment or resale. The issuance of bonds or equity securities. A decline in the market value of inventory as a consequence of government action, barring further sale of a product. The uninsured loss of inventories as a result of fire. A merger or acquisition. Auditors of accelerated filers may also identify events related to internal control over financial reporting that arose subsequent to year end. So there are several tests that we do, and there are two categories that we perform for subsequent events. Number one, procedures normally integrated as part of the verification of year-end account balances. And again, that usually includes cutoff, AP, AR, valuation tests, and then specific procedures that we do for discovering subsequent events. The second category performs specifically to obtain information to incorporate into the current year's account balances. These include, number one, reviewing records prepared subsequent to the balance sheet date. Number two, reviewing internal statements that are prepared. 3, examining minutes issued subsequent to the balance sheet date. 4, audit inquiry corresponding with the attorneys. 5, inquiries of management, talking to management. What's happened since 12/31? Is there anything we need to know and document as part of our internal controls? Number 6, obtaining a letter of representation from management. This is mandatory. Dual dating. I'd like you to make a notation here on your slides that this step has really become very, very rare now. This would come up a subsequent event after the balance sheet date, after the date of the audit report, but before the audit report was issued. In a situation where you have this discovery, auditing standards require the auditor to extend the audit tests for the newly discovered subsequent event. So in other words, you need to expand your procedures. The auditor has two choices here. Number one, expand all the tests to the new date. With this option, the auditor simply changes the report date to the new date. The second option would be to restrict the subsequent events review to matters related to the new event. So again, in the second option, let's go back to our little matrix that we had before. So if you discovered something on March 26th, Option 1 would be is to expand your audit from March 11th through the 26th, make sure there were no issues, and make your new audit report date March 26th. Option 2 would be keep the same date and just dual date it, date below, of March 26th for the one item that you found. Most CPA firms are not doing dual dating. It is a rarity now because the date that we normally put on the audit report is the date that we have discovered and obtained all sufficient appropriate evidence. So again, you're not going to see dual dating as much anymore. Objective 5. Design and perform the final steps in the evidence accumulation segment of the audit. We must always perform a final analytical review. This is common for a partner to do the analytical procedures during the final review of the audit documentation. I'm going to extend that from partner to manager as well, since they're usually involved at the end. And what they'll do is look at the balance sheet, look at the income statement year to year to see if there's any unusual items for which explanations may be needed. And this is a very important step that is done. The other thing we'll look at is going concern. Auditing standards require the auditor to evaluate whether there is substantial doubt about a client's ability to continue as a going concern at least 1 year beyond, this is important guys, this slide is outdated, 1 year beyond the auditor's report. It is not the balance sheet date. It is the auditor's report date. So in the example we used of March 11th, 2017, we have to make a decision if the company will be around until March 11th, 2018. How does an auditor evaluate going concern? Will the client be there? They'll use analytical procedures, discussions with the client, knowledge of the client's business, looking at the client's projections, forecasts, knowledge of future events. A final assessment of the entity's going concern status is desirable after all evidence has been accumulated and proposed audit adjustments have been incorporated into the final financial statements. Obtain a management representation letter. This is a requirement. Usually the auditors will obtain this letter, and again, it's from management to the auditors, and it basically tells the auditors that management has given them everything they've asked for, no questions, no problems, and again, it's on the client's letterhead, addressed to the CPA, often signed by the CFO and CEO. This letter should be signed to the exact date of the auditor's opinion. 3 purposes here. Number 1, making sure management knows its responsibilities for their assertions in the financial. Number 2, reminding management of potential misstatements or omissions. And number 3, document the responses from management to inquiries about various aspects of the audit. When we obtain a management representation letter, auditing standards suggest 4 categories of specific matters that should be included. Financial statements, that the information is complete, recognition, measurement, and disclosure, subsequent events. The PCAOB auditing standards require the auditor to also obtain written representation from management regarding internal control. Remember, that's only if they're doing a Section 404 Sarbanes-Oxley type audit where they give an opinion on internal controls. Consider supplementary information in relation to financials as a whole. Sometimes financial statements have supplementary information, schedules in the back that the clients want to show. Maybe statistics, maybe a breakdown of expenses. Auditors have to distinguish their audit and reporting responsibility for the primary financial statements and for supplementary information. What's our responsibility? Read. Read the other information if there's an annual report for a publicly traded company or even a private company. We have to read it. The responsibility to read the other information included only pertains to the information that is not part of the financial statements, but is published with them. If the auditor sees that there's inconsistency, so in other words, if there was a gain because they sold a building, which is unusual for them, but management makes it sound like this is part of the normal operations, you as the auditor have a responsibility to say something to the client. Say, hey, that's wrong. You need to change that. If not, the auditor should include an explanatory paragraph in the auditor's report or withdraw from the engagement. The sixth objective: integrating the audit evidence gathered and evaluate the results. At the end of the day, has the audit gathered significant appropriate evidence to render an opinion? All the work we have seen this semester, all the documentation we've done, has led to this question: have we gathered sufficient appropriate evidence that if somebody comes up to us in a court of law, we can defend ourselves? The profession often will have auditors use a checklist, which gives you a list of items that maybe you did overlook. Hopefully you haven't, because again, you don't want to go back to a client at the 11th hour and say, oh, I need to do more work now. Sorry. They're not going to respond to you too kindly at that point. And here's an example. Evidence that supports the auditor's opinion. An essential part of evaluating whether the financial statements are fairly stated involves the auditor's review of the summary of misstatements. In addition to known misstatements, the auditor must consider possible misstatements. Meaning that, again, did you find any mistakes? Were those mistakes corrected by the client? If they weren't corrected, we need to bring that up to those charged with governance, the board of directors, and let them know that you found entries, they're immaterial, but management didn't want to book them. And again, this is very important to let the management know that, and the board. Financial statement disclosures. Usually in auditing, we fill out a financial statement disclosure checklist to make sure that the client has captured all mandatory requirements from GAAP. Here's an example. Property, plant, and equipment. Are the following disclosures included? Balances of major classes of depreciable assets. Allowances, a general description for the major classes of PP&E. Basis of evaluation. And different items. This is a checklist. And again, if we look at question number 3, our details of sale and leaseback transactions during the period disclosed, we would look and say, hey, no, they're not. Let's go back and see if they're material enough that they should be disclosed. Once you've decided you have enough evidence, we then begin what's called the audit documentation review. Usually conducted by a manager or a partner. And again, why do they do this? Number one, evaluate the performance of the inexperienced personnel, the juniors. How did they do? As a senior manager, when I go through work papers, I give an evaluation of how my staff did on that audit. Number two, make sure that the audit meets the standard of performance. And number three, counteract bias that often enters into the auditor's judgment. Make sure those work papers are pristine and that nobody can question them. Nobody has a problem with them. Except for the final, usually quality control review, the review of the audit documentation should be conducted by someone who is knowledgeable about the client and the circumstances. Again, usually in a CPA firm, the partner will review the risk areas. The managers will review everything else in the binder. Engagement quality review. In some larger audits or riskier audits, firms will have what's called an engagement quality control review. This is somebody who works in the firm but has not participated in the audit. They'll look at your financial statements, and they may even look at the audit file work paper. Again, somebody not involved with the audit. Usually, if you are doing an SEC, publicly traded company audit, usually an engagement quality review is required. And that person's job is to make sure everything was done and that no questions can be raised. And again, engagement quality reviewers sometimes will not look at the entire audit file, but they will look at the audit work papers for certain items and certainly look at the financial statements to make sure no questions jump out and nothing seems out of ordinary. An engagement quality review person will also assist in the summary of evidence evaluation. Have you gathered enough evidence? Issuing the audit report. The auditor should wait to decide the appropriate audit report to issue until all the evidence has been gathered. That's the final step. Again, once the CPA, normally the partner, is comfortable. Objective 7. Communicate effectively with the audit committee and management. Communicate fraud and illegal acts. Should you find any fraud and illegal acts, that needs to be communicated in writing to the audit committee, regardless of materiality. If you find fraud and illegal act, you need to communicate with them right away. Communicate internal control deficiencies. The auditor must communicate in writing significant internal control deficiencies and material weaknesses. What are significant deficiencies? What are material weaknesses? These are items that are so bad for the client's internal controls, it can lead to a deficiency in financial reporting. Other communications to the audit committee. Generally, 4 types of purposes. Number 1, communicate what our responsibilities were in the audit. Number 2, provide an overview of the scope and timing of the audit. Provide those charged with governance with significant findings that you may have found during the audit. And obtain from those charged with governance information about the audit. Those charged with governance may tell you as the auditors what you need to do. They may tell you to look at an area specifically or to evaluate management's take on a certain accounting rule. So therefore, we try to meet with the audit committee before the audit and post. Sarbanes-Oxley requires additional communications for the members of public companies. As the audit is completed, the auditor should determine that the audit committee is informed about the initial selection of any changes in significant accounting policies. A management letter could also be issued. This is generally done to give some best business practices for certain functions of your client's operations. It's not required, but some CPA firms do give it, again, to kind of show some of the practices that they see with their other clients. Objective 8. Identify the auditor's responsibilities when facts affecting the audit report are discovered after its issuance. Hopefully you never come up with a situation like this, but God forbid you discover that something comes up that you should have known about that makes the financials materially misstated. The auditor has an obligation to make certain that users who are relying on the financial statements are informed about the misstatements or change in the conclusion on the effectiveness of internal controls. So if somebody was relying on that report that you issued, you have an obligation to contact them immediately. And it is then their responsibility, ladies and gentlemen, to take whatever actions are deemed necessary. Usually, you then recall the financial statements and reissue the report. Now, I'll be honest, if that does happen to you, that's a very big problem, because someone's going to say to you as the auditor, why wasn't this caught? And that's why, again, when you have a situation like this, usually CPA firms are very, very sensitive in terms of recalling a report. So, again, this is subsequent discovery of facts. And that concludes our discussion on this chapter. We ask you to please reread it one more time before completing any and all assignments that you may have. Thank you and all the best.